Hi, this is Randy Finney with Right Side of the Chart, and this is an early session update for Wednesday, May 12th, 2021. It's 10:30 Eastern as I'm starting a video. I wanted to see how things traded after the first hour out of the gates today, and so here's where we're at. We're going to start just a quick recap on the markets, and then, like usual, highlight a few other things that might stand out, some of the things I've updated recently. I'm going to get to talk about Treasuries, crude oil, and some of the commodities. And let's start out here with QQQ. So kind of in summary, the case to be short, to swing short, is continues to strengthen recently. And kind of recap everything, we've had some sell signals here on this 60-minute chart of QQQ. Most important developments, we put in a divergent high, broke, trend line there, and then we gapped down. That was a big sell signal for me on the Qs, at least when we took out 334 right there. Went on to hit that gap support right there. Bounced as expected, hit it a couple times, and then went to the top of my bounce target zone. That's that little box right there. And so from there, an impulsive rejection. So that helps to validate that, and it shows you, the sellers were lurking in the shadows, waiting, and they sold hard at that gap. In other words, the buyers, the bulls, had an opportunity to step in and buy. And remember, it's speak metaphorically. I'm talking about buyers, sellers. Those are the forces in the market, supply and demand. When you have more demand, something goes up, and when there's more supply or sellers, prices are gonna go down. It's really that simple. Now from there, we came down, and then that was a objective short, or the next sell signal when those recent lows were taken out. We gapped down, hit that support level. That was yesterday morning when I did the update right there. I laid out this bounce target zone right here, and you can see so far just shy of the top of it and another rejection. So the point being that the market is, the sellers, the technical analysis is working right now, favoring the bearish case, because we're, as you like to do, it's objective to short in one of two ways. You either short a break of support, like you did right here, or you wait for a bounce back into resistance, like you could have done there at the bottom of the bounce target zone, or up to the top of the bounce target zone. And then again, yesterday, you had another opportunity. If you covered long, there was a likely bounce was likely. Yesterday's laid out, and then that was your objective short entry, and here we are, and now we're flirting with those lows. So far so good, and the takeaway is, I'm going to just jump over. This is this 60-minute chart is near-term stuff, and it's back and forth, and I understand if you don't do this full time, or if you're new to it, it might make your head spin. Hard to keep heads to tails, but again, these levels are all laid out in advance. You'll have to be proactive. That's the thing about trading, is more so being proactive than reactive. If you felt like shorting right here on that first drop, well, no, you missed most of that leg down. Now you can be reactive, if a trade goes against you, or if a breakout occurs. There's being reactive right there on the breakdown, shorting, and then being proactive is, or I guess you can look at it as reactive if you're looking to short the bounce back into resistance or there. But let me loop around. All right, that's all short-term stuff. This is bigger picture. So now everything I just said, the case to be short is strengthening. But it's much stronger here. And again, if you're not into that active trading thing or watching longer term charts, here's the first sell signal in a while. We had a sell signal right here on QQQ, and that was early on in this 12% drop right there that ended in that correction, set up this new trend line right here, which has since been broken. So we had a sell signal, as mentioned the other day. We broke down, back tested, and then an impulsive rejection. We're well below the trend line. So at least on the Qs right now, in QQQ, we have on this daily time frame a solid check mark, and that should open the door to these targets down here, about 310 and a quarter, 297. I think this drop has the potential to take us down to that 297 level, and of course at minimum that 310 level. Now let's look at the S&P 500. We'll start out here on the daily time frame, since that's where we just were on QQQ, and you can see now, forget about all the other lines, but this one right here, this is our primary uptrend line. And we zoom in nice and tight, you can see that's broken. It was broken yesterday, but we hit that 410 or 411ish support right there. As I'm doing this video, we're starting to crack it. So today has the potential to give us, because again, this was, although the trend line was taken out, it was not impulsively, and we have this BOD or benefit of the doubt level about 411 that needs to get taken out on SPYs. So today has the potential to put the other and probably the more important index on a sell signal as well, the S&P 500, the broad market. Because when this cracks, you're going to start to see the financials and industrials and everything else that's been strong lately should most likely follow suit. Right now, or lately, it's been mostly a tech correction with the semis and the big tech, the FANGs and all that. So those are the levels to watch. And one way to look at it, a swing trader, a trend trader could increase their short positions, today if it looks like we're heading into the close and we're going to get a solid close below that 410, 411-ish level right there. All right, small caps. Oh, wait, no, let's go back to where we're on the SPY. Let's go to the 60-minute chart. Here's another example. Yesterday, give you these bounce targets. We hit, that was my big level. Still was and still is. It's at 410.39. So let's just say I was saying 411 on the daily, but when you zoom in, we can see a little closer here, 410.39. So let's call it 410. We're at 410.24 as I do the video right now. In a solid break below that level. That's the level I've been watching for weeks now, waiting to see a break below. We hit it the other day. As I said, that was the first tag in quite a while since really back here, and so a bounce was likely, and I laid out this bounce target zone yesterday for you, and that's it. Oh, well, that's supposed to be a box tool. There we go. And look at that. 1, 2, 3, almost all the candles yesterday, just about all of them, gave you additional objective shorting ops to short at the bottom of the bounce target zone. And had we gone up there, you could have shorted at the top of the zone, and they would stop somewhat above. That's somewhat, by the way, there was a comment under yesterday's post. Somebody made a mention about getting stopped out with tight stops. If your analysis agrees with mine, and you think there's a good chance we're going to get a decent correction, you can use a wider stop. The wider the stop, the lesser the chance you're going to get taken out in a little stop rate or a brief pop above resistance. The markets are tricky. The algos run programs there. Sometimes there's a little buying pressure, and so a tight stop will keep your losses smaller if you shorted, let's say, at the back test. But a wider stop will keep you in the trade, have a better chance of keeping you in the trade without getting stopped out. And at the end of the day, how tight or how loose your stop is really should depend on your price target. If you're only looking for a move down here to this first target zone, and you shorted yesterday, for example, let's do that. Let's say you shorted the bottom of the bounce target zone, and you're going to go to, let's just say you're only going to try to target the top of that target zone right there, about 430.27. Well, that's only 3%. Now, 3% is good for an active trader. If you do 3% on a contract, the ES, the S&P 500 futures, you're putting thousands of dollars in your pocket per single contract. But with a 3% target, you should then have about a maybe 1% stop, maybe a little bit above the top of the bounce target zone right there. So that's how that works. That's a 3-to-1 risk-reward ratio. You're risking, a 1% to make 3% profit. However, when you go back out here to the daily chart, if you're a swing trader and you think we're going down here, as I do, to at least 397 from where you shorted yesterday, that would be a drop of about 4.2%, and then quite possibly more. So therefore, the further down your target is, the wider stop you can allow. And then, of course, on that it gets a little more, that's simplistic view. Also look and see what kind of developments are happening here. If they foil the bearish case and it looks like we're going to make another run at new highs, then you might want a little bit tighter stop. Then let's say you were targeting a big drop in the S&P, let's say, if that makes sense. In other words, if you were targeting down here about a 9-10% drop, you might not want to allow a 3-4% stop loss if suddenly things change. And what could change here? Well, a recovery of this trend line right here in the S&P 500, successful defense of 410, 411, or we'll call it 410. Although if they defended it today, we're still on or just above support. They'd really have to ramp things up back above, run at these previous highs to get us back above the trend line, and especially on QQQ. Remember, QQQ is well below trend, and maybe we go up and back test and then run back down. All right, enough on that. To wrap it up with the equity markets, the other one I like to watch and trade is IWM, and we have our first sell signal in quite a while on the daily chart. We did have a breakdown here, and we had some 60-minute sell signals back then, able to game some of these corrections. But the big, most important level here on the daily chart is this primary trend line off the March 2020 lows. And that was taken out recently, as mentioned, back tested, impulsive rejection, and we're bouncing on this 214.90-ish support. And once that goes, that should open the door for a move down to 205. So there's your next sell signal, pretty much break of yesterday's lows. That should do the trick because we tested that at the lows yesterday. Okie dokie, so that's what that looks like. And Treasury bonds, I wanted to update. They've broken support. And what happened today is, let me grab the headlines here and read it off. I'm on from another monitor. Let's see here. Okay, headlines read, we had the CPI came out this morning, that's the Consumer Price Index, and that surged 4.2% in April from a year ago to the highest level since 2008, raising inflation concerns as the economy revs up. That's reading a headline that was released today. And when you go here to resources on the top menu of the site, click that, go down to tools of the trade, click on economic calendar, and it brings you in and you can see the report. So today's Wednesday, you click on CPI report right here that came out at 8:30, and you can see right here, here's the numbers. So month over month, 0.8% increase. Year over year, 4.2. And believe me, you've heard me. I've been beating on this, harping on this inflation trade for a while. I think that's understated. I think a lot of this is understated. Ex food and energy, and then year over year. So the bottom line is, sooner than later, Powell's going to have to come out, tuck tail, and start back pedaling off his inflation's just, these are transitory forces. They're going to abate. This is real, like I've talked about. So what's going on with bonds, of course, when that number came out, that's hot. Those are hot inflation reports. That causes yields to spike. And then the levels I gave you recently have been taken out. They were actually taken out yesterday, the day before. It was this uptrend line on ZN, the 10-year Treasury bond futures. We broke down right here. And then, as I said, that would be, you really wanted to see it remain above 132.94. That was really the last chance stop, I think, and that was taken out as well today. So again, these are bond prices which are going down because the inflation numbers are hot. That means interest rates are going up. Remember, when bond prices fall, it's simply because interest rates are going up, and interest rates are going up because inflation, Fed's behind the 8 ball, or behind the curve, I should say, on inflation. So that's ZN, and that would be your IEF if you're trading an ETF instead of futures. And then ZB is the 30-year bond. Same thing. This was the trend line highlighted recently. It was broken here. We hit support at 157, 157, bounced, but then back tested and rejected. And then when we broke 157, 157, that's really it. And then we even broke the next support today. So the Treasury bonds are not looking good at this point, and probably exceeded most any reasonable stop. And crude's hot right now, and that's due to that cyber attack on that facility. I forget the name of it, but it's taken down. A lot of gas stations are reporting outages. That's what I'm seeing in the headlines. Even had some friends that told me yesterday they went to a gas station, or maybe even two, here down in South Florida. And that's not in the headlines. They said they were out of mid-grade or whatever it was, one of the grades there. So that's what's going on, and it's causing crude to spike. I did read it should certainly cause gasoline prices to spike, but it may actually end up causing a drop in crude. But we can't figure out what's going to happen there, how that's going to, when that facility will come back online. But I can tell you we're at resistance now. That's 66.50ish right there. Those reactions I just circled. We're coming off a divergent high. Any marginal new high anytime soon will still be an extension of the divergences. And if my call on the market's right, and we're going to have more downside, you're going to see more downside in crude. So, in fact, we had 3 tags. This is the last update I would have posted on crude. Had this support here, 63.94. We've had 3 successful defenses of that level, and bounced from there. But again, any equal high or marginal new high will still have divergences. So unless we can really power on through there, and that's a possibility. Again, that's what stops are for. So if you're short crude or you want to short it here, stop somewhat above. There's that previous high right there. But targets would still be, again, this is even better support now than it was before. Because we have more reactions. We had reactions here, 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 and now we have more recent reactions. So there's your minimum swing target, 63.94, and if that breaks, which I suspect it will, I still think we're going down to any and possibly all of these targets down here as low as 57.49. If that happens, that would be a drop of about 14% in crude oil to that maximum at this point in time, that maximum target about 57.49. And that being hit is largely but not exclusively contingent on the market hitting some of those swing targets on the daily time frame, because crude in the stock market tends to have a pretty strong positive correlation. When future economic growth expectations are rising, stocks are rising, and so is crude oil for that reason. Market's up, people are going to drive more, more trucks on the road, more planes in the air, and vice versa. So again, largely but not exclusively contingent on what the stock market does, because sometimes crude will do its own thing based on unique supply and demand forces that are unique to crude oil and not necessarily the stock market. Gold still moving up, looking okay on the 60-minute chart for now. We don't have divergences. We might soon if we get another thrust up. But again, divergences in a bull trend, typically result in relatively minor corrections. There was a divergent high. Here was a divergent high. Relatively minor correction right back to that 1759-ish, 1760-ish support. So forth and so on. So longer term, I think more and more people will start getting on board with what I've been talking about. I think gold has underperformed because people, the narrative that I've read, a lot of people think that Bitcoin and these cryptos are replacing gold as a safe haven asset and an inflation hedge and all that. To me, it's ridiculous. Gold's, has thousands of years of track record of doing so. And as I've said, and I think this is being underestimated or underpriced in gold, is the industrial applications for gold. You're seeing platinum, palladium, copper, tin, metals across the board rallying in this inflation trade, and yet gold has lagged behind. Most of those metals are at multi-year or all-time highs, and yet gold is still off the highs. So there's the fundamental case to be made, and of course the technical case has been made ad nauseum recently. So let's move on to the next one. Lumber's still headed towards this. My target. We had I'm watching these series of trend lines. You get these minor trend line breaks, you get corrections. Minor trend line break correction. This was the most recent sell signal right here, and we're getting close to. That's a target here on this hourly chart, 60-minute chart. Other than that, when this one breaks, there's a lot more downside on the daily chart. So a break of this trend line right here, we'll probably get a bounce off it on the initial tag, but once we break that, that's going to open the door for a much deeper correction in lumber. And look, I've been bullish on the commodity trades for quite some time, still pressing that, long-term accounts. That's where, believe most of the opportunities are, the better. It's a much better risk-reward ratio than the stock market. But with that being said, they'll correct. Nothing goes up forever. One of my favorites is this one for the one-size-fits-all GCC. There's a lot of different commodity ETFs that I follow and ETNs, but there's our primary uptrend line, and it's getting ahead of itself. Every now and then you come back and you visit the trend line. You visit there, and so sooner or later we'll probably visit that. And if we get a pretty healthy correction in the stock market, you'll probably see a little unwinding of the margin trade. A lot of traders are margined out because the stock market's recently at all-time highs. You get that bullish excesses in the market. Here, I'll show you. Here's this chart shows you the margin debt. Here, I think I can expand it a little bit for you and show you that. Margin debt and the S&P 500. So when you look at this, right here in the blue is the S&P 500. Red line's margin debt. These are your past stock market peaks. Bull market. There's the top in 2000, the dot-com bubble, and you can see the margin debt when it gets extreme, especially when it goes parabolic like this. You see a steep run there. Let me try to color this tool up a little better, and you can see what I'm talking about on blue tool. You see that steep run. That's indicative of a bull market. Everybody, people are making money, and they're saying, "Well, shoot, I'm making X, percentage on my money. Why not leverage up? My broker will give me." Let me buy more stocks than I have money in my account. That's what margin is. When you have a margin account, you can put 100,000, and your broker lets you buy 300, whatever it is. You can leverage up with stocks, futures, and that's what happens. And then that's the reason bear markets are so vicious and so profitable to trade, because it's the unwinding. Once things start going down, it's not just the trends lower, I'm going to take some profits. No. It's forced selling. It's margin call selling. That all those people that were loaded up on margin, and we all know this, or I can tell you, the vast majority, the very, very much the vast majority of positions when you see these margin bubbles are long positions, not short positions. So they're being unwound during the correction, and that's where you get these 50+% bear markets when the credit bubble pops. And look, they also coincide with recessions. See the shaded gray areas? Those are recessions. See this? Yeah, that's a recession. This is crazy. Stock market at all-time highs during a recession. And again, look at that. Look at the trend. Look at where margin rates have surged to. This is a little dated. This is back, April. But I just wanted to show you that chart because I mentioned it the other day and forgot to show it in the video. Okay, so where am I going with this? I just wanted to kind of do an update. Here's another commodity ETF. This one has a little bit higher weighting in crude oil and energy. This is DJP, but it does a good job. It's the IPATH, Dow Jones, UBS Commodity Index Total Return ETN. Beautiful little price channel right there. So it tells us we're in a bull trend in commodities, but you want to look at, within any trend, especially you recognize a well-defined price channel like this, and you're going to have corrections along the way. So if you want to sidestep, or at least this tells you, hey, this was the time you wanted to be loading up if you didn't already have some, or adding to your commodity positions. This was a good time. This was a good time. Pullbacks to the bottom of the channel. But when you get to the top of the channel, that's usually it. In this case, you had several tags at the top of the channel. Even though it was early in its formation there, you really wouldn't have identified it until afterwards. But you did have a nice, clean little uptrend line. See these purple trend lines? So when you're at the top of the channel, it's kind of a heads up, hey, maybe sit tight with what you have, and if you're a really active trader and you want to set some stops to prevent a give back, a correction back to the bottom, then you could stop out there. There was the price channel there. There was your breakdown, took us to the bottom of the channel. So this is what I'm watching right now on this particular one. And you're at the top of the channel. We could stay there for a while, but a break of that's probably going to bring us back down to the channel. And again, that may coincide with a big correction in the stock market because of, there are traders that have, and investors that have, pretty good stake in commodities, but also have stocks. And I do think that we'll probably see both of them fall. There's been a strong positive correlation for quite a while, really since the March lows, between commodities and the stock market. So by that logic, if that correlation remains, then if the stock market corrects, commodities might correct too. So where to make money? Well, bonds aren't looking hot right now, at least not long. Stocks aren't looking hot. Commodities are getting a little frothy, and again, for the reasons I just stated, may correct. So really shorting right now is where I see the best opportunities, best risk-reward ratio. And one thing I'll say, I've been wrong before and will be wrong again. So if you are a bull and you don't want to short, or you think this market's got a lot more upside to go in this bull market, then you buy support. You look for example, what would be bullish? Well, to see the S&P snap back above 410, 411, especially to see it solidly regain the trend line, take back that gap, go back to those 60-minute charts I showed you, look at the bounce target zones, see those bounce target zones violated or taken out. In other words, we move up beyond those. Things like that, and that would be a bear trap. And there's a break of my 410.39 right there as I'm doing the video. Bearish as long as we're below there, but if they can recover above that level, that's near-term bullish, but it's not get out of your shorts. It would only mean another successful defense of 410.39. What starts to chip away at the bearish case is a violation or a move back above my bounce target zones, like that one in SPY and that one in QQQ. All right, let me see if there's anything else that stands out. No, I'm just going to wrap the video up here, just pointing out a few sectors to keep an eye on. There's XLV Healthcare starting to crack. If I wanted to, I could take that line down there and catch that candle. I like this fit as of now better. There's more reactions there. So there's a breakdown in the second largest sector in the S&P 500. We already know tech's the largest. Tech is clearly in correction mode. XLF Financials, this one's been really strong. There's your trend line to watch if that breaks, and that's going to further add to the bearish case in the S&P 500 and the broad markets. XLC is already broken down. This is a communication sector, which is really made up of Facebook and Google. They represent about half of this sector in the S&P 500. They've taken out the trend line as well, primary uptrend line. We could do a benefit of the doubt right there line, but I like this one again. I think it has a better fit. And there's a breakdown flirting with the 50-day moving average now. So any more downside here, that yellow line, see how it comes in and it acts as support. A break of that solid break below the 50-day will also have taken us down below the trend line and probably open the door for a move down here. Really wasn't trying to list this as a trade idea, but I'll give you targets if you want to trade these individual sectors. The point I'm trying to make is the more and more sectors that break down, there's 11 sectors in the S&P 500, so if you have 11 check boxes, the more check boxes you have, the stronger the case you can make to be short for a swing position. So XLY is another check mark here, breaking down recently. And then the industrials have been strong, very strong recently, and they're right at primary uptrend line support. So these are the things I'm watching. Again, we'll open the door for more downside in the market if and when, like for example, XLI takes this out. The industrials are probably going to come back down to about 93. That'd be about an 8.5% drop. So that kind of gives you, rough idea of where the targets, what the downside I'm looking for on the broad market. That anywhere from, say 8 to 10% right now. Which, to wrap the video up here with the S&P 500, which again is cracking right now, take us down, I think, to about this 370, 320 level right there. I think that should give us that roughly drop of about 9% right there. So there's a kind of a swing target for you if you're if you're short or you want to get short, you want to tuck some things away with the appropriate stops above. Because remember, if nothing else, this has been one of the most resilient bull trends in quite a while. But evidence continues to build for the case for a decent correction. So I'm going to wrap it up here, and I will continue to focus on looking for some new trade ideas as well as updating those that I've thrown out recently. If I see anything else that stands out, I'll either get it out in another post today, or I will follow up in the comments section below this post. This has been Randy Finney with Right Side of the Chart. Have a great day.